Good afternoon and welcome to our featured panel session. We want to introduce some of our panel speakers. First up is our moderator, Dwayne Purvis, PE. Dwayne Purvis is a seasoned professional with over 27 years of experience in reservoir engineering and geology. He has dedicated his career to tackling complex challenges in the oil and gas industry, focusing on valuations, reservoir development, reservoir management, and strategic decision-making. Dwayne is a registered professional engineer and has held key roles as a consultant, business owner, and leader in multiple oil and gas production companies.
Next, we would like to introduce Gavin McQueen. Gavin is the president and CEO of Anthem Energy Partners. He has decades of experience in oil and gas exploration and production, but at Anthem Energy Partners, Gavin has achieved remarkable success in fundraising via a new capital model. Gavin and his team developed a new acquisition model for oil and gas assets to safeguard investor confidence. Through the creation of new investing vehicles, Anthem Energy Partners allows investors greater control and advocacy within organization, purchasing, and growth scoping. Gavin has raised significant rounds in Europe to grow Anthem Energy Partners in the U.S. domestic oil and gas market.
The last member of our panel, Laura Freeman, is the founder of High Point Global Capital. High Point Global Capital is a Houston-based specialty advisory firm focused on the oil and gas industry. High Point Global specializes in acquisitions and divestitures and assists clients on a wide range of complex issues when both experience and discretion are key. Laura has been nominated by several oil and gas media publications as a 40 under 40 speaker. She has been a part of hundreds of panels and presentations, and we are happy to have her share her expertise with us today. Without further delay, please welcome Dwayne, Gavin, and Laura.
So good morning, and thank you all for joining PHDwin Week and our panel discussion about trends and in the oil and gas industry, things that are unfolding now that we're going to have to wrestle with. Well, I am very pleased to have today two guests, both with great background that fits really well, I think, with this audience. First, we have Laura Freeman, who earned an undergraduate degree in physics, which I just think is cool. I'm always impressed. But then dual masters in business and petroleum engineering, so that she brings a unique combination of genuine skill in both technical and financial issues, and spent most of her career advising companies on acquisitions, divestitures, also doing some technical consulting through her company called High Point. And in total, she's worked over $8 billion worth of transactions, including a number in the last year. Mm-hmm. And most importantly, Laura is somebody who sees independently and expresses her independent opinions well, something I really value. Also, we have with us Gavin McQueen, whose history is also long and is a who's who list of independents, XTO and Samson, and his own companies, Sage and now Anthem. Started as a technical background, worked into a business background, but at this point, besides having worked in independence and private equity, Gavin is running his own oil company, has successfully raised money, and has been very active in the A&D market. So both of these folks are deeply involved in a broad spectrum of what's actually happening in the industry, the kind of things that independents are wrestling with. So both you guys joined the industry some time ago. What was the good old days when you started? What was the good old days about how things, how companies built and ran? Laura, take that one first.
I really try to see the silver lining, as you know, no matter what the situation is. But when I first joined Occidental out in California before they spun off CRC. And I think for me, what I really see missing now or not there is kind of how employees were treated. And I know that
How
may sound a
employees
little
are
bit
treated.
odd, but
Yeah.
there are a lot of very smart people in oil and gas. And over the last several years with COVID and even before that with '08 and some difficulties in the market, you don't see sort of that coherent community that you used to. I mean, I think we see it in events and organizations, SPE otherwise as well. But when I first joined, there was a lot of really smart people with a lot of pride in their work and what they did. There was always, a little bit of trouble with corporate America and leadership, but I feel like most people had a lot more confidence in the folks running companies and the future, and we're proud of the work they were doing. We're able to do interesting technical work. And since then, you've seen budgets go down and remote workers and lack of company loyalty, layoffs. So I think for me, the good old days was everybody was in there and excited about the projects and working, and
Yeah.
there's a real team environment. And
It's a fascinating take, Laura, that what you see as the good old days, the most salient feature to you was the work, the nature of the work environment, and the people you were working with.
And
Interesting.
I feel like people were valued so much more when I started. It wasn't, with the private equity age and the mergers and things that have gone on, I almost feel like
Yeah.
folks are treated as disposable now.
Yeah, for a lot of young people, I think they don't realize that there was a time before all oil companies were funded by private equity.
Right.
But
And
Gavin,
before some of the bankruptcies and, the '08 sort of crash was hard and fast, but then there's so much leverage in the industry. And then, in 2014, when the price crashed, it's been a different world since then.
Yeah.
And before then, there was a lot of community. There's a lot of really interesting, smart people working in the industry, and we liked going to work. I don't know, there's team spirit and a lot of confidence and leadership too, a lot more confidence.
It's pretty ironic that we're producing as much oil, more than any country ever in the history of the world, but the community seems to have broken down some. Gavin, you've worked in the private equity, but also some time period before private equity was the only game in town. What was it like at the beginning? And in a minute, we'll draw a contrast to where it's gone.
Yeah, I think you're kind of calling me old at this point, Dwayne, but I'm just going to take it as experience.
You got nothing on me, man.
When I came out, that's a magical time. I came out of Texas A&M and, petroleum engineering. I had some great paying internships with XTO Energy, and I went to work for them in 2007. And of course, the price of oil was ripping at that time. I came out of the Permian Basin even at that time. So this is pre-Wolfcamp, pre-Bone Springs horizontal, doing Wolfberry focus, multi-zone. We're picking perfs and we're doing some legitimate engineering. So we were still doing a lot of geology and a lot of engineering and vertical wellbores with pretty complex procedures in its own right. The shale boom was upon us, but of course it was gas shale at that time. Oil was too thick to flow through a nano Darcy perm, right. Remember? So we were funding the gas shale growth, which XTO was very active in, with kind of conventional and water flood, CO2 flood oil out of the Permian. But the price of oil was up. So it was this really magical time of strong commodity price, emerging technologies, kind of a boom cycle in shale. And there was just so much to learn on either front. It was just incredible at that time. It was fun. It was fun. And to Laura's point, you very much were valued, and you were compensated. And I actually did not know how good I had it. We worked hard and we played hard and we just had a blast. It was a really fun, magical time in the industry.
Yeah, it was. I remember those days mostly because I was sitting on the sidelines watching everybody else get rich in the shale boom. Don't laugh.
it's all relative at this point.
Yeah, it's all relative at this point. It's a good point, Gavin. Well, but the culture changed, the kinds of work we were doing changed, but I think the financing has also evolved. The kinds of projects we're doing and how we finance them have been evolving. Gavin, tell me about that. How did the types of projects and the types of financing evolve?
Well, if you go way back, there's a strong argument that there has always been a form of private equity in our industry. You go way back, it was the promoter, right? It was the early day promoter, and sometimes that promoter was the operator, sometimes it wasn't. So there's always been private finance in our industry, and I would argue it's played a very important role. In really in the 90s, the kind of the current 2 and 20 or the American private equity model as applied to upstream, came into vogue and really did well. And the guys that you're speaking about who were really making a ton of money, that model worked exceptionally well in a boom cycle, right? Because we were paying for PUDs. Additionally, because price was up, your PDP was very valuable. So the banks were willing to lend on a true reserve-based loan. So your loan was truly predicated on your reserves, PDP plus your PUDs, because both had value in the market, right? People were paying for those. So they were collateral good. So, yeah, I mean, it was very frothy. There was a lot of money out there, and a lot of your private investors wanted to come through private equity versus publics for the benefit of kind of, a 3 to 5 flip and a bigger multiple, bigger MOIC. We make it happen quicker, right? So that model carried forward and really, and I would also say there were strong, we were the sweethearts of Wall Street on the public side as well. And so a lot of it is relative to what was going on in the industry with the advancement of shale and the technologies that came with it and the proliferation of the U.S. emerging as a dominant world producer, right? That, of course, we had the 2008 housing crisis, prices collapse, and then pops back up. And then we really start getting into the Wolfcamp and the Haynesville's role and the Marcellus, and we're finding oil and gas and shale everywhere, And so we do what capitalistic Americans are so good at doing. We can produce. And we can do it cheaper and cheaper and cheaper. It's kind of the Walmart model in a sense. And it's wild because the technology that we are deploying in the subsurface, miles below our feet, is so advanced. I mean, we take it for granted how quickly our industry can advance in technology. But as we advance in technology, we proliferate the amount of reserves we can get at a lower and lower cost basis to do so. And so we oversupply the market on one hand, and have done that a few times now. Gas is oversupply now. And maybe oil is getting there depending on price. But the problem with it was that impacts the financing and the financial models deployed, and how, a bank views collateral versus equity. Well,
I was watching the system evolve, and I'm legitimately old, I think, Gavin. The cost of doing business, the cost of playing, really spiked. When Texas first created its high cost gas tax abatement, if you drilled like a $600,000, $700,000 gas well, you got a tax abatement, because that was a high cost well. And now the average well is like $8 million. And it did, in the explosion and the exploration of shale plays, it really did fit the private equity model well. And between those two dynamics, it seemed to squeeze out, at least temporarily, a bunch of other kinds of financing.
Well, it's a good thought experiment, right? Because if you're in the operated space and you want to play in the shale game, we're now customarily drilling 2-mile laterals at a TVD somewhere between 8 and 12,000 feet. So you're talking 20,000+ feet of lateral, and there is no casing point election. You are going to drill it, encase it, and complete it. Yeah. So, let's just take $100 million. Okay, well, if I got $100 million to play with, and I don't have 6 times cash flow or a 6 times EBITDA RBL, I've got sub 2, and I think they really want you at 1.25 or something. So you got to buy some PDP typically to access your PUDs. That's going to chew up a big chunk of your $100 million plus some of your debt. And so let's just say that on a really good day, on your $100 million, you get 50% in debt, which is probably optimistic, but let's just say you got $150 million to play with. You spend half on the PDP, you got $75 million left. And if your well cost is $8 million, how many wells?
What's that, Laura?
That's not a lot of wells.
It's not a lot of wells.
I mean, I think that's the point is, people don't and you overpay for PDP at the moment. And so even something that seemed like a lot of money, oof, I mean, there's just not, it doesn't go nearly as far as you'd think, even 100 million with debt, like he just said.
Yeah, Laura, it's really back to this idea.
We're talking about those numbers.
Yeah.
Yeah. It's a big boys game now. Mostly it's a big boys game. And I think we kind of, Lord, did you see the same thing? The private equity tended to dominate high capital needs, higher capital needs.
In my opinion, there's different kinds of private equity. And I think this latest kind of dynamic, I call it the aggregator model. I think Gavin, mentioned 2 and 20. And that's where you've got an in-cap or Kane, or I'm not going to badmouth anyone particularly, but you have this. It's not like Scout or Merit where it's direct, and it's not like high net worth individual, but you have an aggregator, and the problem is they're also a middleman. So they're putting together all the limited partners and the money, and then they're deploying. What I personally saw is that model, well, it really happened with the price crash back in 2014. And so in 2008, the price dipped, but it went back very quickly. And then in 2014, it just tanked. I mean, we went from $100 a barrel to 25, and it was so fast. I mean, it's kind of like Vegas real estate, right? It was, nobody jumped ship because 2008 had bounced and it kind of went off the cliff. And so you had what should have been a lot of distress, and Chesapeake makes me laugh, especially since they're, the biggest gas company we have now, basically. But they went so far, undercovered on the borrowing base that the bank went under 1 on coverage ratios, which means you're not covered. And they just didn't look at it for a year. But you had this sort of bottom fallout and sort of all this debt that no longer, had reserves or cash flow behind it. And also because of what had happened with 2008 housing markets and everything else, oil and gas was one of the lowest defaults of any industry. So a whole bunch of debt was in, the bottom drops out. There was over $1 trillion in private equity overhang at some point there, because everybody raised private equity thinking these companies would go bankrupt, which in an actual free market they should have. And what I saw happen is that with the model, private equity gets, the 2 is a 2% annual fee of assets under management. And if you have $1 billion fund, that's a lot of money, right? And so this money was all raised and there was nowhere to put it because these companies, some rules got loosened. And I'm not saying that's necessarily wrong with the amount of default that would have happened, but companies that should have had distress didn't and hung on a long time. And then, it took a few years, the banking regulator finally changed some rules, but there was all this private equity and you end up in a use it or lose it. And so if you don't deploy the money, you don't get the fee and you're not making money and going. And then what happened from there is that the Permian was kind of the best place to try to put it. You had stacked pay, you could, of the other considerations, and if it's use it or lose it. And so what I saw in this last round was this massive influx of this private equity that had to get put to use somewhere. And then as Gavin has said, that kind of private equity model, it works in a boom cycle because there's a lot that hinges on the exit. And so, the people that timed it right and got rich, and that's also why you saw the bubble happening. And so you just it created its own monster that ultimately had to do with the US and our debt situation, ironically.
Yeah.
But then you saw that change. You saw in kind of early to mid 2017, private equity was getting priced out. So if you look at how many public versus private buyers, that type of model wasn't working, because if you want to, it's ultimately a buy and flip. It's a 3 to 5 year hold. You got to buy it cheap. You got to sell it quite a bit higher to make it work. And as the assets got more and more expensive and this bubble got created, there no longer was enough room to appreciate that fast, right?
Yeah.
And so that kind of led to the mismatch of why people say it doesn't work, but there's sort of lingering concepts. And
Gavin, what was your perspective on the pivot in the 2014-15 crash?
I think that was an interesting time too, actually. I remember, I spent most of the bankruptcy, post KKR acquisition. It was KKR, I think NGP had a piece, Itochu, Crespi Partners, and there were several that bought Samson. It was a $7.2 billion acquisition. I think it closed in 2011. And so the company experienced pretty significant price exposure as commodity prices went down. But we were everywhere. I mean, we had 2.8 million net acres across 19 states. So we had a pretty big playing field. But commodity price volatility, and again, this dynamic of paying for upside that wasn't really even proven out. I mean, it was that frothy at one point where people were even paying beyond PUDs, right? Especially if you had a lot of exposure. As prices collapsed, of course, we had, debt on the company. It was leveraged. We had bonds ultimately on the company. And it just, that private equity structure with that much leverage just wasn't sustainable. And that's why, you remember the Boons and Haynes report, that the law firm that was tracking all bankruptcies. I mean, it's just fascinating to pull that report during that time. It was massive, and it grew exponentially, but then there were others that really drug it out. And actually Samson's bankruptcy took, over 2 years. And I wasn't even there for the whole thing because it was taking so long.
Yeah. Good for you. That's a beating.
It was a beating. I learned a lot, a whole lot. And, but what I came away with was, so there's a lot of different forms of private equity, but that kind of 2 and 20 model, at scale across a whole bunch of stuff can still be difficult, or as difficult relative to the example we gave earlier of if you're too small and just can't ante up to play the game, right?
Yeah.
So Laura's right in that. So let's look at the ones who have been successful. Where are they? Well, they're in basins like the Permian that have a lot of stacked pay, where the drilling has very robust economics, where your basis deployed brings forward a ton of inventory that's reliable. They're well managed, and they have the pockets to go after and build a position to make it something that then is attractive for whomever the buyer would be.
Yeah, it sounds like there are narrower opportunities that fit the historical funding models. But if banks retrenched, and as I recall, we lost half or 3/4 of the banks half in 2015 and half in 2020 of the banks that were lending. And then private equity retrenched, didn't reload. What's the status of those two historical funding sources? If an independent company wants money right now, is there anything available in private equity? What's available from banks? Laura, what do you think?
You take it first, and then I can give my experience.
Yeah, I think there's a variety of sources. What I'm seeing is it's harder to get capital. There's plenty of private equity that'll still sign teams up if they pay for it with their life, and they're never going to waterfall, and the term sheets are god awful. I think there's plenty of there's quite a bit of capital. There's people looking to buy, there's people, the acquisitions have honestly been tougher. I've dealt, somewhat less with the banks in recent years, although with Venture, we had a quite large borrowing base. As Gavin spoke to a few times, there's less, the banks got burned and OCC regs changed as well. So you're just not getting nearly as much as you were. So that's more limited. I think a lot of it, what I'm seeing right now, as far as getting deals done and getting capital that actually can be deployed. Well, the other thing with private equity, as Gavin mentioned, is at this point, if they're not funding G&A and it's bring me a team, bring me an asset, then they can fund a team without, or they can be looking to place capital without nearly as big of a commitment. So, I'm seeing more, I've actually been surprised that the number of buy and sell side deals that have been going the last few months for us, and we're starting to see some things loosen there. But personally, I think it's been more of a asset market than a capital market issue.
I'm sorry, explain that to me, Laura. What do you mean by an asset market instead of a capital market? You mean a seller's instead of a buyer's?
No, like if you want to deploy capital, if we have Dwayne and Laura's high net worth, or we have Gavin's private equity, or people would like to put money to work, but it's hard to buy with I think things are overvalued to some degree, and then it's hard to find the right fit of an asset that will meet. Well, one problem with the model of private equity you've been talking about, you have to make a pretty big margin to pay everybody. And so if you're taking the 2% and the 20% and you're taking these cuts, it's kind of like buying a house on a credit card, right? So for the portco, you get to point, you call it never outrunning the pref, but it's like the interest rate's so high, basically, or the cost of capital is so high, you can never really get out of it. And that's one reason you also need you need a boom cycle or a swinging commodity. You need some kind of big price, value increase in a short time. And there's so many things about that, right? You can't really buy assets cheap enough. You can't really sell assets cheap enough. Gavin mentioned you can be too small and you can be too big. If you have a minimum size and there's not lots of places where you could buy a big enough asset. It's all about that, like the margin and the delta.
Yep.
And I think that's much harder to achieve right now.
It's a great point, Laura. And I do think you're right that the people in the industry look at it differently. Back in the day, I think a lot of people had stars in their eyes about how much money they were going to make. And I saw some people do 6X in 18 months. Fabulous. It was good for them. Right. But this is a very strong survivor bias. And I think the events of 2015 and then again in 2020, when the teams were treated so poorly, I think that the management team side of the equation views private equity with a lot more suspicion and distrust and disfavor than they have in the past. Are you seeing that, Gavin, or are there other drivers?
I think capital is extremely hard to access on the private side of our industry in general.
Yes.
I think that applies to direct invest structures. I think it applies to private equity. It applies universally. I think institutional investors are going back and looking at where they've had success with the larger PE firms, and there's a comfort level there. There's an understanding that they have the scale, that they have the expertise and the track record. I think the mid cap and small cap private equity structure, some people have called it dead. I just think it's antiquated because you don't have the liquidity coming in from the RBL banks like you used to.
You can't leverage to get the returns you need.
That's right. And for all the reasons Laura said, all the way back to the OCC or the FDIC regulated side of telling banks, like, you cannot have that type of exposure or that much exposure for an asset class of that level of risk. So, it's really, really hard. I think, there's some on the technical side too. And there's a lot of motivations out there at the end of the day, but early in the shale game, you know, it's a widget factory. There's no variability. We can put 32 wells in a unit. No problem. We can stack them all you want. You know, it's like, that's not true either. So I think we all, you know, bear some of the blame. And at the end of the day, whether it's the model, whether it's the technical combination thereof, or the motivations that exist behind the parties involved, at the end of the day, if we're not paying the LP, the investor back, whether it's a limited partner or direct investor or whoever it is, if we're not making a return on their capital that they've entrusted us with, if we're not acting as the true fiduciary in giving them a return, then that equity leaves the space. And then it doesn't really matter what your debt markets are doing, you know, whether it's the bond market or an RBL or some other term loan. If we cannot be financial and technical fiduciaries to our investor base, they leave. And so a lot of them have left. And you know, and there's in 2020 price collapse associated with COVID, but also kind of just the wokeness or the run from fossil fuels and run towards renewables. That was real as well.
Yeah, and there was a big swing late 19 and for a period, basically up until the SEC ruled that they weren't gonna, you know, do the ESG auditing that some people were afraid of. I mean, there was a major consideration there for a while.
Has that stalled now? Sorry, go ahead.
I've seen it stall, yeah.
I think so. But like, I think 2020, maybe I was in 21, I saw, you know, renewable and ESG investments were 2-to-1 on the private side to upstream. So I mean, that's a massive amount of capital that otherwise likely would have been allocated to our business. So
the discussion of ESG has dropped way off. Mm-hmm. But have you seen a reversal? Did it stabilize or did it reverse where nobody cares anymore?
I mean, personally, I saw a lot of changes. I mean, just look at, you know, Larry Fink and look at the pressure to deploy. And I mean, my experience with ESG was more working with larger private funds where they were actually mandated to deploy 1% of the funds under management into ESG. And so what I saw was that really increasing the drive to put I mean, some of these funds are giant. You had endowments and states, and if you start adding it up, I mean, it was more money than there were investments. And I think if you start looking at, well, there's entire pension funds that have left, you know, some of these high name funds that were trying to push towards ESG. There's states that are out of it now. I don't know. It kind of swung so far one way. I'm not sure reversal like back from a 0 point, but it definitely has come way back from kind of where it hit when everyone in the run up to the SEC decisions.
Okay. So I did observe the same thing. Yeah, there's a large period of time there where the industry was not meeting its promises. The public equities for oil and gas were absolutely flat over 10 years, and a lot of capital was destroyed. You know, notwithstanding the investor presentations that said we're getting 70% rate of return on every well, there's this massive disconnect between what we advertised and what we delivered, and I think that cost us, I believe. But there's on top of that, there's this push to do something else. But have people come back? Are they seeing the returns again? Are they getting out from under the pressure where they're a little bit more, a lot more, or all the way back to the kind of pressure to the kind of willingness to look at oil and gas?
The business is normalizing. And so I think now people are starting to understand the technology that we've developed quite a bit more all the way around. You know, especially within the operating companies relative to spacing, whether it's, vertically, or we call it the shotgun view, or horizontally. We're better understanding. We're still making improvements in that technology, increased spacing in stages, et cetera. And then, learning that a shale isn't a shale. They're all different, and, whether they have higher plastics or more clays or whatever, and they respond different to different types of stimulation. So we're really honing in on that. And, I'll give a shout out to Grayson Mills. Look at what they're doing or did in the Bakken. Great sell to Devin. You look at some of the technology. Well, they're literally changing the well orientation and drilling 3-milers over legacy single mile swell packer and sleeve system. So we're going back, and we're just, now that's not universal across all basins, right? So we're having to bring back a level of sophistication that we used to apply to conventional, which just calling it conventional doesn't mean that it's simple, but we're bringing back a level of and building a level of expertise where we just understand it better. But at the same time, outside of Permian and maybe a couple other core areas of certain basins, the market's not paying for PUDs. In fact, they're giving you a pretty steep discount on the PDP and expect to get the PUDs with it.
Okay, so I heard a little bit of disconnect between your perspectives there. Gavin, you're saying that they're always paying for PUDs, but maybe even not paying enough for PDP. What I heard Laura say earlier, and correct me if I got this wrong, was that PDP is kind of pricey.
To cost of capital. It's always relative to cost of capital. Interest rates have gone way up.
Interest rates are up, and then the hurdle you have to meet with private equity. I mean, that's kind of like the house on the credit card example. If that's my cash under my mattress, I got a lot lower cost capital than if I'm buying on a credit card. And so the industry kind of swung to the situation with real high cost of capital. And so just even your baseline of where you had to start. And then for a while, there was in the boom cycle, you can appreciate enough. But as those dynamics change and cost of capital is quite high. I mean, if you think about some of the financing models now, they're very expensive. So you almost can't pay for PDP because you couldn't hit your hurdles and make it work. There's just lots of complexities, and it's all, people like to kind of look at it across the board as trends and what's happening. And there's just, it's kind of become very personalized and specific, I think, to the setups.
But you have to understand it to be competitive and to be successful in the market. So I'll give you an example, Dwayne. Banks used to predicate their reserve-based loan issuance on PV9 PDP, plus or minus, right? SEC public reserves, typically to be considered proven, it would have to be PV10. It'd have to breach the PV10 threshold, right? So that was referencing an average of cost of capital prior to those rules being put in place in SP monograph 5. Okay, so today, you're probably going to have to deliver an 8 to 10% pref on private equity just to get the GP into their 20% carry. To get the team who is actually beyond the GP into any real money, you're going to have to deliver, 1.2. So your actual cost of capital is the 20% plus the 8. That's 28%, right? So if you're thinking about it from the perspective of the team getting into the money and you're not going to get value for the PUDs, then that purchase price that you make at the onset, that basis is what sets your investment and your potential for putting any money in your pocket after you've done the vast majority of the work for however many years it takes. So that's it. It's always, and by the way, the interest only RBL debt that was at a really low interest rate, that diluted that cost of capital, which is why it was so popular. Mm-hmm. But now they're not lending 4 times. They're lending 1.25 or something. So the dilution utilizing that form of debt isn't there to offset a pretty high cost of capital. So at the same time, public markets, like I heard a gentleman told me the other day that they're seeing returns at large on equity in the 20 to 30% range. So we still got to be competitive to bring the investors to us.
So what you're saying is that the people, the investing pool is seeing 20 to 30% equity returns in other industries, and we've got to compete with those returns in other industries. That's painful. So, but unpack to me the discussion about how bank lending has changed. It used to be interest only, and it was truly reserve based.
You could get a lot of lending for PUD. I mean, they do 50% value for PUD, but you just double your PUD volume and get all of it. You throw a water flood in. So you start, say you have a PDP number. I mean, there's a contribution amount. And so it's, like I just said, half for PUDs. And it used to be basically 100% of your PDP value. And it was PV9. And that was a large number. And so really because of how over leveraged everything was coming off of 08 and ramping into 14, and then how the bottom fell out. And I mean, it's kind of a miracle the banks haven't had a lot worse problems. And then going into COVID, we were right on the edge of a whole bunch of defaults, and banks were actually trying to get the SEC to do some new rules where banks could operate. And there was a bunch of stuff expected. And then I laugh, I'm like, saved by the Rona, but everything kind of paused just enough, and then prices spiked. But there's this massive exposure in banks that became obvious. It's a miracle there wasn't a lot more wipeout with it. And so the amounts that they'll lend have gone down a lot. And one thing, if you're on the private equity model, you have your equity commitment, and that's a pool of money, but it's real expensive. And so what you really need to do, and Gavin's kind of mentioned this, but for folks that maybe not quite as familiar, if you need to go drill and develop to get that appreciation to get the team paid, but you really don't want to be using your super expensive money to do that. And so the other things you do are you try to get into cash flow to pay for your drilling program, and you try to use the RBL cheaper money to pay for your drilling program. And so that's how you can kind of dovetail these. And, the bank money's now, there's less of it and it's more expensive. It's these underlying currents of massive exposure that they most kind of sneaked through and buy really changed that market. And then a lot of banks have left the space. So I'm sure Gavin knows more about it than I do.
Yes, fascinating discussion. Gavin, what are you seeing? What are banks lending?
No, Laura, you're right. I think a number of smaller banks have left the space. The bigger banks have just really culled down what they'll lend on RBL, kind of referencing it as a working capital loan structure, which kind of tells you like maybe not the best structure to use for an acquisition. So it kind of leaves you with some term loan options, which of course, there's a true P&I amortization with those structures, which I'm not against. I actually think that whether you had an RBL that was interest bearing only or not, you should have been paying down some of that principal as you go. I think that was, we were kind of addicted to that debt for way too long. But yeah, it's you're seeing really big deals get done that have pretty not only large PDP bases, but also a good amount of running room. You're seeing some of those get done on the private side, and that's because they can put quite a bit of debt to work, hedge it out, and everybody feels pretty comfortable that debt will get paid off through kind of a term loan structure. But I think that's where the industry kind of has to lean at this point on the acquisition front. And of course, it has to be of a bigger scale. That's really what we've started to focus on is, how do we finance acquisitions, and are they of scale to fit both the equity investor and the credit investor?
Okay. So without revealing the secret sauce, what can you guys say about how teams are successfully putting together money now?
A lot less of them are doing it.
A lot less of them are doing it. Yeah,
if you look, there's some graphs that are shocking of how much private equity is getting raised and committed, and how big that drop has been.
Yeah, I mean, some of the firms I've spoken with, it's taken them well over a year and a half to raise new funds, and the time that they used to could do it in 4 to 6 months. So they're going to be much more choosy. And of course, this goes back to Laura's original question. There's a great or comment that there's a lot of great people out there, technically capable and competent, who aren't being treated very well. And it's simply because there's not enough money to go around to treat everybody well. And that's just kind of where we're at, unfortunately. And so your team, you kind of have to find a way to finance your team. It's why we have Anthem Consulting, like we it's all kind of word of mouth and through our network that we provide these services, but we're pretty darn good because we know how to run oil and gas companies and develop asset bases. And we've had exposure through these past experiences across the US, but you got to find a way to self-support, right? None of this is free. The software is expensive, the overhead's expensive. I mean, it all adds up. Plus we got to eat. We got to feed our families. So it's really hard right now. You have to be extremely committed, and you have to have a team that is extremely committed to doing the same thing. Yeah. And so what's the trade-off? Well, the trade-off is when we find something that is attractive and we can lock it up, and we've done the underwriting and all the engineering and the geology and everything that goes into it, and then we go to capital sources, perhaps the same capital sources private equity has been successfully going to, just go directly, then you have to express all that, hey, we've done this on our own dime. We've done all the underwriting. We've covered the overhead. We're in position and under CA for the deal.
I wish it only cost a dime.
Yeah, I'm going to ask for more. I mean, what a great deal. Yeah, it's hard to raise money for the PE firms, but what a great deal for the PE firms. I got a team, an underwriting, a deal on the hook, and all I got to do is add a little bit of cash and water, and poof, you got to come.
There you go.
Well, now I have read this, and I've seen it with at least one client, that the companies that are successfully deploying money are raising it directly from private investments, family offices, and the kind of people who used to go to a PE company. But there's going to be fewer of them, but the ones that are successful are going straight to the equity investors.
I mean, what size of investment though? Because that sort of that. I mean, you're not wrong, but I think everything's just a lot more nuanced now of who's being successful and why and at what scale and all the pieces. So I think to what Gavin said real quick, what I'm seeing is experience matters a lot more. Your reputation and integrity over the years matters more. And then the deals that have surprised me that we're getting done right now, both on getting funded and assets, people are really gravitating to working with people they trust. Mm-hmm. And there's people are, I think are, sort of, we found a lot of unique fits where it's like all these pieces are here with you and here with you, and this dovetails correctly. And then there's relationships and experience, and we're not really seeing just the kind of brand new pop-up team with good resumes and a lot of young folks work real well.
It's a great point.
And that point cannot be understated, Laura, that, our reputation, our ethics, our ability to do what's right and be that fiduciary at whatever level you're in is so important. And that has benefited us. The teams that can give the honest technical assessment, who can properly financially model it, and who have a history of being honest about whether it's good or bad, whatever the situation is, here is where we are. That is a huge feather in your cap. So, so with that, who do you go to? Well, you try to go to the people that know that about you and who have deep pockets.
It helps if you graduated from a private high school in a big town.
high school, big town.
Yeah, not as much as it used to, I think. People are kind of tired of the promises, and so it's like,
Yeah.
are these people going to actually deliver or not? And there's so many horror stories of, we stopped doing geology and went to closology, and there's operational nightmares within this private equity model that are unbelievable. And
Well, I
for
love
a
what
lot of
Gavin
years
said
there, I think.
earlier.
Oh, go ahead.
No, I'm sorry, please.
I just, for a lot of years now, being honest and having integrity and walking away from certain things made a lot of us feel like everyone else is making money, and my gosh, this is maybe not the best way to do business. And in the last couple of years, I think it's gotten so nuanced and complicated and tight in the fits and the capital and the asset, the operations, the limited opportunity set, that I've just really seen a pretty remarkable shift in people want to deal with people they know, and they know they're going to tell them the honest answer, whether it's right or wrong. If something's going wrong, they're going to tell them early, and it's not going to be a surprise. And I got some horror stories on that of people misleading investors way beyond the point of no return. And so, I mean, to me, that's been fun and exciting as well, because you're starting to see some doing the right thing matter, and doing the right technical work and doing the right operations work. And I think that is one thing in the difficult market that makes me more excited.
Yeah, that's a great point. And I love what Gavin said earlier about we were doing some legitimate engineering. We were actually doing some science. And it's a good point that we're going to have to go back and spend some more time doing legitimate work, figuring out the stress reorientation. And for example, and what comes out
operations have just become so important. I think with some of the ways the private equity model evolved, and like just the attitude and leverage finance and other things, a lot of money came in that treated operations folks kind of like you recapitalize a hotel or a restaurant, and as you put a couple new executives in and the workers just keep working. I mean, there's just some like not having multiple options on water disposal and losing all your flow back during fracs. And also, like, what I call it, there's the dumb blonde price they offer in Midland, and the PE guy price is even worse. But some of these, what they're telling people, how many days they're telling them it takes to drill a well. I mean, this is fundamentally like a boots on the ground business. The oil's in the ground, and the operations are not simple either. And I think that I guess in my personal experience, I think we got away from respecting operations from the finance side, and thinking that was kind of just easily replaceable cogs in a wheel.
Yeah, that's
and it's technical. You got to get the inside of it, and that's becoming more and more important. But you're absolutely right. The relationships and your reputation isn't just those that you're asking for capital from, but the real proof of your reputation and the kind of person you are the other relationships of the people you're working next to and the people that you're hiring, including the service companies. And if you want to be successful in this business, you better have good relationships and a good reputation with those people that you've hired and who've put their time, effort, and product towards your operation to make it a success, because so much of what we do depends on the service side.
You better treat your people well.
You better treat your people well. Yeah.
So I think of the group of assets, the group of fields that are available in two families, right? There's the shale plays, and really the shale plays have two families. One is places that are pretty mature, past their peak, and some just a couple that are still growing, still expanding. But then there's the whole family of middle Darcy fields, conventional fields. It looks to me like there are different life stages and different kind of technical challenges, different kind of risk return profiles. How is the market different? The seller's market, or the assets coming to market, how do they differ? And how does equity investment look at them differently? Do they prefer one or the other?
That's a hard question. The short answer is yes, because it's also by basin. So I've started to view each basin, whether it's a shale or whether it's a conventional or unconventional basin, I start to think about the basins of how much liquidity is actually in that basin. So the existing companies, how liquid or illiquid are those companies? Because they're the ones who have investors in. There's more and more view of consolidation, but is there actually enough capital currently in the basin to consolidate or to pursue further, growth of one business over the other? That's a question. And then to the extent that there's not, which I think there are several illiquid shale basins, kind of your tier 2 shales, if you will, is there anybody outside of the basin, any investor willing to say, how do I come into this basin, buy really, really well, and do that consolidation? So that's kind of how I think about now tier 1 shale. You're still getting, some incredible acreage, $30,000+ an acre in the Permian. So they're basically still paying for PUDs. They're still going to pay you for the PDP. I think gas is even in Haynesville and Marcellus, you almost need to have like a global strategy at this point. Somehow you got to get the ARB built in from global markets, which you saw that parity in 2022 Ukraine war run up. You saw the parity between the Dutch market in particular and NYMEX, and it was incredible how well they tracked different. One was way up here and one was here, but the tracking of it was just remarkable. So I think you will see more of that, and that's why you still have some contango in our gas price. But at $2 gas, you gotta be able to drive that margin through that correlation somehow. And I think the best way to do that is to be able to do business across the pond, or somewhere be in that commodity space. Oil, in the spring, everybody thought we'd be undersupplied. Now it's kind of feeling like, well, maybe we're not going to be undersupplied. And it's a volume game there, but your barrel margin is a lot better than the molecule. So you've got more room relative to the cost of services, right? So for me to drill a 2-mile horizontal well, whether it's in the Haynesville or whether it's kind of deeper part of the Delaware, kind of the same cost, but I've got more margin in the economics on oil today, right? So it's and then conventional. Conventional is interesting right now because I think it was Chevron who just paid a pretty healthy number for the Avance North Montgomery field, right? So and that probably has something to do with CO2 would be my guess. So, the class 2 wells can also act as sequestration. So you've got kind of that coming back into those conventional fields. But then there is a game to be played for the behind pipe conventional strategy. And where I see smaller companies really having a lot of success is they're going back and they're looking at kind of stacked sand pays, and they're doing the geology and the stratigraphy to say, hey, there's a nice zone there that's going to IP at 20, 30 barrels and it's sub 3,000 feet, and those economics work pretty good. So that's the local deals that you can kind of make if you know folks in those markets.
Laura, how are people in the market viewing the ARO, the decommissioning liabilities of conventional assets? Is that affecting valuation? Is that affecting equity investments?
I mean, your great Colorado report, and you're an expert on that. I think that it's changed a lot. It's no longer a warm fuzzies, and it's no longer like a punt it forever. Where we really first started seeing it come into play, I mean, we, sort of the run up to the 16 Permian kind of peak there, it was no one was worrying about P&A whatsoever. And in Texas, you can defer it a long time. And then we saw, honestly, I kind of with your asset classes, we saw, several folks having some difficulties entering the horizontal markets and kind of looking to go back to conventional. And then there was a lot of asset packages where it depends largely on the state and situation, but, in Texas, there were packages where even if you did a pretty realistic model and you kind of punted it and you said they were only 20,000 a well, all of them, and if you look at AFEs, that's really not true. You started to see the P&A liability actually be on the order of magnitude of the PDP value in a lot of cases. And so it kind of, for me at least, it got to this point with a lot of the packages and a lot of this that had hung around in Texas where, I mean, that's material. And it just, I think I've been forever, I was, you can P&A it for the cost of salvage. I know like 2 companies that can do that in 2 states. So I think it's becoming a lot more real. I think, when you're looking at assets, which state is it in? How much is there? What are the AFEs actually running? You're seeing a lot of places where even vertical P&As are costing $80,000 a well, and people will say you're crazy, but I'll show you the AFEs. So I think it's become, for a while there, it wasn't really even part of the discussion, and it was, you just punt it and drag it along and blanket bonds. And I think that, I think people aren't necessarily taking it quite as seriously as they should be, as far as how real it is and how fast some of it might come. But just the buildup in order of magnitude has become quite large.
Yeah, I've thought for a lot of years that the attention and the relevance are only going to go up. And I've been telling my clients for years now, if you buy it, you have got to plan on burying it. You won't be able to sell it to somebody who's going to ignore it, to ignore the decommissioning costs. Well, how are all these dynamics going to play out in the next few years? We've just had a year worth of unbelievable mergers. And a number of those have said they plan to spin off a couple of $1 billion worth of non-core assets. And historically, those were mergers and spin-offs were a feeding frenzy for independents and smaller folks. Is that going to happen again? And how? What do you think, Laura?
I think it remains to be seen. I think it's be really interesting. We've swung way too far on some models that don't work in the current environment, whether it's the operations, the purchase of assets, the financing. I like what Gavin said, that the business is normalizing. Some of that's faster than others, but I think that's interesting. And then the corporate consolidations are quite fascinating right now. It's sort of textbook MBA 101 of a later life, not so healthy industry to see this consolidation happen. I think it's be really curious to see what breaks loose or doesn't. You're seeing some problems already where, Oxy for one with the Crown Quest or Crown Rock purchase, and it's like, oh, we'll buy it and then we'll sell some, or we'll get some debt, and people are having some trouble with that. I think there's quite a bit of energy in the system, which may sound kind of silly, but sort of it's normalizing because it's a little bit out of whack and a little bit imbalanced in a lot of places, whether it's the people, the operations, the financing. Those spinoffs of selling non-core take a lot longer than people think, end up being a lot more complicated. And I just, one thing that also excites me, because, I like a little bit of disaster, is like there's just enough chaos in the system and it's just unstable enough. I think a lot of interesting things
are gonna happen.
I think something has to give in a lot of places. I think it's be really interesting to see how big and what sizes, and is it new teams or groups? Gavin's having success, so he's got at least one lead of the future figured out, I think.
Yeah. Well, what kind of opportunities would you be looking for, Laura?
I'm being careful right now.
Oh, okay. Oh, be careful not to give away the secrets, or being careful what you buy.
Careful what you buy. For me, I think, the Venture experience with Vita was fascinating. We went from 3 people on Costco tables and fold out chairs to 2 billion overnight. And it was wild and fun. And I'm not sure I'd do it again, but it was great once. I was doing reserves and IT and A&D and calling the pumpers and putting signs out. And we got the great Civitas exit. So, but I think for me, it's just, I think it's really probably this little bit of chaos and unsettlement in the business. And I'm kind of sitting on the sidelines a little. We're staying involved with helping folks in A&D and litigation and M&A and things, but I'm kind of waiting to see what trigger points, how it normalizes and where to go.
It's guaranteed to be exciting, right?
That's what I like.
Yeah, it's a great point. What was it Rhett Butler said? There's a fortune to be made in the building of empires and in the collapsing, maybe not collapsing, but but the chaos that comes.
We really look at fit, and I think that comes back asset type, state, ARO or not, it's counterparties. And so, we consider a lot of things, a lot of different types of assets, but ultimately, I think it comes with experience, and it comes with seeing a lot of disasters over the last however many years. Like, it's almost like a marriage. It's like all those pieces got to.
It is. And Gavin, sounds similar with your experience. You were telling us earlier that you've bid 52 or 53 times. I'm sorry, looked at 52 or 53, bid on how many, won how many?
5.
Yeah, so
right?
we bid on 5. We haven't won any to speak of, but part of that's being careful. But you're gonna have to kiss a lot of frogs here, right? And they all have warts. It's just a question of what do the warts look like relative to what could it end up? Could it become a prince that is really something that other people could find value in? Your investors could find value in, and how do you portray that value to your investor base? So we were working in a very linear fashion, one deal, the next deal, the next deal. Now we have multiple lines in the water. We've become much more proficient, and part of it is you just got to get in there and start doing the work to better understand your investor base. And one thing, if you can cultivate some investors, and we're project finance, so we work up each deal. We're not raising blind pool funds. We work up each deal. So we have the full deal worked up, and we put it out in front of our investor base. And some will say I hate it for this reason, and the others will say, well, I kind of like it for this reason. Others will say, well, I've already got exposure there, but it's a cool project, I just can't take any more of it. And then sooner or later you'll have one that says, wow, that's awesome, we really like that, what's next? And it's hard to say exactly. You'll know it when you see it. Because you start to build a basis of like, well, I know the majority of my investor base doesn't want to see this kind of economics, and they don't want to take this type of risk. And so you'll figure out kind of what your group is looking for, and then you just focus in on finding that, and don't waste time on other projects that don't fit the investor base that you've culminated. If because there's always lots of stuff out there. So I'm kind of speaking out of both sides of my mouth. You do have to get multiple lines in the water, but you got to be careful which ponds you're fishing.
Yeah, well said. So it's probably about time for us to wrap up. But it sounds like what we've decided, agreed on, is that the financing side has gotten a lot harder, but it's getting done, and getting done in different ways. Mm-hmm. The asset side has a lot of frogs with warts, and it needs to be a good fit. But there are still opportunities to be had, and what you've got to do is put those two together.
Well, and the folks that it's gotten real complicated. So the folks that are successful are folks like Gavin's team, where you've got a long track record, you have experience, you've been through it, you're working up these deals harder, you're doing the details, you're understanding your investors better and more. And so there's just, it's become almost like a craft again, I think, to a large degree, with years of experience and the small details that you only learn that way, and paying attention to it's not just like a kind of, this is a great deal for everybody.
Yeah. No, I love that. Like a craft again, as opposed to 31-year-olds getting hundreds of millions of dollars and stumbling into some good acreage.
Well, I've been doing some bit of woodworking, and boy, I'll tell you what, I could tell people exactly how you do it, but being able to do it and do it well is a whole different story.
Great point.
It really is. And I think it's kind of like what Laura said, with VTOL, challenge yourself to figure out who is out there in the market deploying into commodities, because with high inflation, there are a number of investors who like to have commodity exposure. There's a whole bunch of institutional investors and endowments who always have some exposure. So go figure out who those people are. PitchBook's a great resource. Bloomberg can be a great resource. Think through where's the dollar coming from? Who is the investor? And what might they be looking for? I would just encourage everyone who is looking to start a company to really think through that, and then buckle up, because you will have to expose yourself and your processes and your valuations numerous times to really get them comfortable with you.
Yeah,
So,
you got to build it up way before you bring them a deal that they're going to close. There's a relationship
absolutely.
that's got to be intact for a while. And you got to
Absolutely.
think about stuff a little backwards. I think, like Gavin's saying, some of these assumptions where it's what previously, like looking at deals linear, people thought you did it this way. Maybe like, okay, this is a challenge in the current market, but for what investor is that backwards and actually does that work for?
Guys, thank you both. Thank you for your time. Thank you for your insight, and thank you for your optimism. I look forward to talking with you guys some more. Jonathan and the rest of you guys back at PhD Week, back to you guys.